You will have heard of bull markets, bear markets and crashes as they relate to the stock market. However, it is important to realise that these phenomena are primarily caused not by real-life situations, but by the general mood of investors. By interpreting the mood of investors and what kind of market is likely to result, you can to some extent predict the rise and fall of financial markets for several years hence. The bull market. A bull market is a market in which share prices are on the upward trend. Prices usually dip for anything from between 1 day and 1 week, but then begin to rise again. Bull markets last for approximately 4 years, rising most sharply after the first 6 months. In a bull market, confidence is high, and investors continue to buy shares even when the financial experts suggest that prices are too high. The bear market. A bear market is a market in which share prices are on the downward trend. Prices usually rise for anything from between 1 day and 1 week, but then begin to fall again. Bear markets usually last no more than 1 year. At the end of a bear market, share prices normally begin to rise, regardless of the economic climate at the time. The crashed market. A crash is defined as a fall in stock market prices of or exceeding 10%. Crashes are very difficult to predict. However, they normally occur when prices in all the world's financial markets have been rising to previously unknown levels for at least 2 years or more. So far as financial traders are concerned, the most important thing to know is that following a market crash, stock prices takes approximately 2 years to return to their pre-crash levels. A prime example of how fundamental changes can affect us was over the panic in Asia. So-called experts were constantly telling us that UK share prices will be hit hard once the effect is felt over here. These were the same experts who only a few months earlier were raving about the tiger economies and how we should all learn from them and adapt accordingly. 12 months later, we did feel the effect. But by then, the market was prepared, and although the FTSE and US Dow Jones indexes did take a little dip, the markets quickly picked up again.